This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Flashing yellow, investors appear cautious, but business leaders are the most confident they've been in years about the direction of the U.S. economy.
Gold rush. The precious metal hits its highest level in months, but does it belong in your portfolio?
New deal. Amazon Prime is offering a big discount to some, and it's taking on Walmart in the process. Those stories and more tonight on Nightly Business Report for Tuesday, June 6th. Good evening, everybody. I'm Sue Herrera.
And I'm Bill Griffith, and tonight again for Tyler Matheson. Stocks slipped a bit ahead of a number of key events that are still to come this week. Investors seem to have struck a cautious tone as they await the testimony by former FBI Director James Comey, the upcoming election in the United Kingdom, and next week's meeting of Federal Reserve policymakers. While stocks were a little changed overall, investors bought bonds, and that sent the yield of the 10-year to its lowest level for this year. Gold prices also hit their highest level in months. We'll have more on that in a little bit. But first, today's closing stock prices. The Dow Industrial Average fell by 47 points. It closed at 21,136. The NASDAQ was down 20. The S&P 500 dropped by 6.
And while investors aren't making any big moves, business leaders are optimistic. In fact, a new survey shows CEOs are more confident in the U.S. economy than they've been in years. Kayla Tausche has more.
Each quarter, the Business Roundtable takes the temperature of 148 CEO members about their plans for the next 6 months and their optimism about the U.S. economy. The survey out today showed a reading that is the highest since 2014, but that's flattened after a big jump in March. On sales, the group remained bullish. On capital spending, they expected small increases, but plans for U.S. hiring in the next 6 months actually dropped, as did the outlook for this year's GDP growth. Now CEOs expect 2.0% GDP for 2017, down from 2.2%. The CEO of the group, Josh Bolten, former chief of staff for President George W. Bush, said that optimism is underpinned specifically by tax reform, and that if it hits the skids, CEOs are going to be quick to reduce their current plans. Bolten said, quote, "What policymakers should take away from that is U.S. businesses remain very optimistic, but there is also a potential downside from failure. That should add to the urgency with which they pursue the reforms." The survey took place between May 3rd and 24th, 3 weeks when the House passed its health care bill. The president fired then FBI Director James Comey, but corporate America has made it clear it is optimistic, but conditionally so. For Nightly Business Report, I'm Kayla Tausche in Washington.
Right now, there are more job openings here in the U.S. than ever before. According to the Labor Department, a record 6 million positions were posted at the end of April. Hiring, however, decreased, and that gap between job openings and hiring may suggest employers are having trouble finding qualified applicants.
It may be one of the hottest housing markets in history. A new report from CoreLogic shows a nearly 7% rise in home values versus April a year ago. But that 7% is down just slightly from the prior month's annual gains and may indicate that homes are getting too expensive and unaffordable for some prospective buyers. And that's why CoreLogic lowered its forecast for annual gains to just about 5%.
Well, while the stock market was quiet today, it has been up quite a bit this year. The Dow Jones Industrial Average has gained about 7% just since January. But not all 30 stocks in that index are enjoying this rally. Dominic Chu looks at what's driving it and what's not.
The Dow Jones Industrial Average has gained close to 1,400 points so far in 2017. And with regard to what's powering the Dow, it's been a pretty narrow range of stocks. Now, 8 stocks in the Dow have been responsible for just about every point of those gains so far, and 3 of those stocks are responsible for half of them. So when it comes to the Dow, which stocks are the ones driving the gains and which ones are the biggest drags on it? Well, we put up our thermometer here just to give you a sense of what's powering the Dow. First of all, no surprise here, Apple stock has been on a tear so far this year. As a result, and because of its price-weighted index nature of the Dow, it's added about 263 points overall. Boeing, also a bigger point contributor, 225 points of that near 1,400 point gain comes from Boeing, and then 207 from McDonald's. So again, those 3 stocks responsible for about half of the overall point gain so far this year. As for the biggest drags, take a look at these stocks here. You've got IBM, Big Blue, taking about 93 points off of the overall index's value year to date so far. Chevron about 98 points. And the biggest drag so far has been on the financial side of things. Perhaps no surprise there. Goldman Sachs dragging about 167 points off as financials have been laggards so far in the trade this year. So as we talk about the Dow, fairly narrow range of stocks powering the gains there, much like in the S&P 500, where the top 5 stocks in there, like Apple, like Alphabet, like Microsoft, like Amazon and Facebook, are powering many of the gains there. These few stocks are the ones driving the gains for the Dow so far this year. The question is whether that becomes a detriment in the future. You'd like to see larger participation for that bull market. For Nightly Business Report, I'm Dominic Chu.
As stocks have rallied, so has the price of gold. That's a bit of a surprise since gold is often viewed as a safe haven and stocks slightly riskier investments. But this year, gold is up about 13%, closing in on $1,300 an ounce. As we told you last week, a new report suggests that adding alternative investments to a traditional portfolio of stocks and bonds has historically increased returns. So, should investors consider adding some gold to their holdings? Here for a strategy session is Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. Brad, welcome. Nice to have you here.
Thank you for having me.
Let's start, first of all, with how you feel about gold overall. As we mentioned, it has had quite a run.
Well, I think gold does deserve to be part of your portfolio longer term, but the question is not, should it be there? Yes, it should. The question is, if you're not into it right now, should you add it now? And I think the answer is probably not.
You want to wait to see it get back to the old high. Is that the idea? It prove itself. If it's going to go much higher from here, it needs to exceed that previous high before you would get in here, right?
Not necessarily the all-time high, but what we know is over the past several years, gold is typically stalled out at about $1,300, maybe $1,350.
Right.
We're getting right to the point where it's stalled before.
So if it breaks through that level where it stalled before, you would go in, and if so, how would you do it? For the average investor, what type of vehicles would you use to own gold?
For the average investor, it doesn't really make sense to own bullion or coins. The best way to invest for the average person are two of the ETFs that hold gold. One is GLD, the other is IAU. They're both actually good ways to get exposure to that without the costs and the risks of holding the physical metal.
I've been asking for the last few years here, what makes gold move? Do you view it as the traditional inflation hedge that it's been viewed for years, or has it become a risk asset to some degree here?
I see gold as insurance. I see gold as something that goes up when everything else goes down. If you look at the data, it's actually not an inflation hedge, although people do see it that way, and that seems to be part of what's driving it. But when concerns rise, gold is the place to be, and that's actually what makes it a good part of a portfolio.
On that note, Brad, thank you very much. Brad McMillan with Commonwealth Financial Network.
Still ahead, does hope float? Why the troubled oil tanker industry is betting on it. The U.S. and Mexican governments have reached a new agreement in principle on trading in sugar. The deal was announced by Commerce Secretary Ross, and it calls for Mexico to export a smaller portion of refined sugar and a larger proportion of raw sugar to the U.S. U.S. producers have not endorsed the agreement, and in a statement, they expressed concern that the deal contains a major loophole.
The companies that transport crude around the world are hitting some rough seas. Tanker industry profits are getting squeezed as a result of good old supply and demand. And as Morgan Brennan tells us, it's not clear when the tide might turn.
The Ann is the largest oil tanker ever to call on a Gulf of Mexico port. It did so recently in Texas. A test by Occidental Petroleum to see if the shale producer can more directly load its crude onto ships destined for Asia. This comes at a time when oil shippers are desperate for new markets. The global oil supply has treaded water amid OPEC production cuts. At the same time, dozens of new tankers ordered several years ago during the oil glut are now being delivered.
And the reason for the market's challenges is mainly on the supply side, meaning there's too many ships relative to the amount of the number of cargoes, number of oil cargoes in the market.
As a result, shipping rates are down dramatically, and fleet operators are feeling some pain.
If you look at the VLCCs, which is sort of the largest ships, the bellwether of the market that everybody focuses on, I think that market was average maybe in the $50,000, $60,000 a day range in 2015. At the moment, we're looking at the market which is in the high teens, low 20s. So it's definitely a quite significant downturn.
Tanker stocks have tanked this year, but analysts say investors would welcome consolidation since it would create more discipline for supply and capacity. And the deals have already begun. TK Tankers is merging with Tanker Investments, and Frontline has reportedly set sights on Generate Maritime. Meantime, crude exports from the U.S. have doubled since last year to more than 1 billion barrels a day, and more is heading to Asia, meaning once the infrastructure is there, more supertankers like the Anne may soon call to ports in the U.S., creating a new bright spot for the struggling sector. For Nightly Business Report, I'm Morgan Brennan.
Sales flatline at arts and crafts retailer Michaels, and that's where we begin tonight's Market Focus. The company said that customers spent less in the latest quarter, resulting in overall revenue that was roughly the same as a year ago, and that missed expectations. Profit also came up short, with Michaels adding that same-store sales would be lower than expected in 2017 due to a weakened Canadian dollar. Shares fell more than 8% as a result to $18.16. Macy's warned that its profit margins are tightening and will be weaker than originally forecast. The company did reaffirm, though, its full-year revenue and earnings outlook, but investors did not care about that. They sent shares down about 8% today to $21.90. G3 Apparel Group posted a smaller than expected loss and said that it expects to return to profitability this year. Parent company of brands such as Donna Karan and Tommy Hilfiger saw sales rise as strong demand for its Calvin Klein dresses helped results. G3 also raised its sales outlook for 2017, and the shares soared by 15% to $22.92.
Speaking of apparel, the clothing retailer Land's End says its loss widened as overall sales edged lower, and those results were weaker than what analysts were expecting. Nonetheless, the company said there were some bright spots in the latest quarter, including higher same-store sales. Land's End also said it focused on several initiatives that it hopes will drive its future performance. The shares, though, were off 10% to $14.95. General Motors shareholders rejected a proposal by investor and hedge fund Greenlight Capital to split the automaker's stock into two classes, one offering dividends, the other benefiting from earnings growth. GM CEO Mary Barra spoke about Greenlight's plan.
We value the voice of all our shareholders, but as we went through and looked at the aspects of this particular proposal, we thought it provided several elements of risk and that was not in the best interest of our shareholders. So it wasn't one thing, it was doing a very careful, thorough, and objective analysis.
GM shares fell 3 cents to $34.43. And the restaurant and gaming chain Dave & Buster's reported profit and revenue that grew and topped estimates. The company also raised its full-year forecast, but investors seem to focus on only one thing, same-store sales. They grew, but not enough to beat expectations. Shares initially fell in after-hours trading, but finished the regular session up nearly 3% to $70.17.
The CEO of J.Crew is stepping down. Mickey Drexler, he's going to be replaced in July, but he will remain as chairman. Drexler is known for his turnaround of The Gap back in the 1990s. He came to J.Crew in 2003 and succeeded in introducing the idea of providing designer quality clothing for the masses. But the retailer has hit a sales slump lately, just like other apparel brands, and is currently burdened by a heavy debt load.
There's a new front in the battle between the world's largest traditional retailer and the world's e-commerce juggernaut. Amazon is offering a discount on its Prime membership for people who have low incomes and receive government assistance. Those consumers can pay $5.99 a month for a Prime membership, which typically costs about $10.99 monthly. According to Morningstar, the discounted rate will be available to nearly 20% of the U.S. population. It's a segment of the market that Walmart has long dominated. Last year alone, nearly 1 out of every $5 spent using the assistance program was spent at Walmart.
So, is Amazon's Discount Prime membership for low-income shoppers on government assistance a good idea or not? We have both sides of that debate right now. Derek Thompson is senior editor at The Atlantic. He says it is, while Joe Rideout, a spokesperson for the consumer advocacy group Consumer Action, disagrees. Joe, you feel like this discount won't actually serve the targeted audience that it's going after. Why?
Well, to begin with, I think it's just too much money for someone who's just struggling to put food on their table without assistance to expend another $72 a year to sign up for this service. It's something of a discount from $110 a year, and kudos to Amazon for trying to come up with ways to reach out to new groups, but I just don't think this really makes that much of a difference, particularly when it comes to getting groceries.
And Derek, I think you think it does make a difference.
Well, sure, it makes a difference. They're giving them about a 50% discount on the product. That's much better than a lot of other tech companies do. A lot of other companies don't necessarily offer discounts to people just because they're on SNAP, they're on food stamps. Look, no one's forcing any of these families to buy Prime memberships. I have some friends who have Prime memberships, love them. I have others who don't, right? People can make their own decisions. I think it's good, though, for a company, even if this is pro-profit, even if this helps them in the long run, it is good for a company to recognize that income inequality is a huge part of this country's picture and to develop policies based on it.
But what about, to Joe's point, Derek, that this could be tempting for people in the lower income bracket? Now, some of these products are available to them with that easy shipping that Amazon offers here.
Sure, but there's nothing evil about easy shipping. There's nothing evil about buying anything from Amazon. You know, pizza is tempting, food is tempting, candy is tempting. But I don't think there should be moralists who say that people who are low income, who are on SNAP, shouldn't buy potato chips, shouldn't buy pizza, shouldn't buy candy. I think that we should have government programs that help people who have low incomes have more income. That's the point of government transfers. But once we transfer that money to households, we should allow them to spend money on what they value. And if they value toilet paper, they can buy toilet paper on Amazon. If they want towels, they can buy towels on Amazon. If they want food, food on Amazon. But this it doesn't necessarily put money in people's pockets, but it's a discount for low-income families, and that's a good thing.
Yeah.
Joe, do you want to respond to that? Because I think there is a worry about perhaps the thought that Amazon might be exploiting the fact that these people are lower-income people that are trying very hard to put food on the table and at lower prices, certainly, with the Prime. But tell me how you feel about the points that Derek just made.
Well, to Derek's point, I will certainly agree that more competition, that's good for consumers. And here's another option for them. The problem is a bad option, and it's not going to save low-income consumers any money. To Derek's point about once the government distributes benefits, it's someone's option to spend it as they see fit, as long as it's a qualifying purchase. Let's look at what Amazon does. You can't use food stamps to buy Amazon food in 47 out of 50 states. If they really want to help low-income Americans who are struggling financially, they could start right there and allow all Americans to use their food stamps to buy food. And to add on to this $72, I really should point out that for anybody who thinks that we're going to be helping low-income Americans in food deserts with this Amazon Prime reduced rate, to get Amazon grocery delivery, you actually have to sign up for another service with another fee of $14.99 a month called Amazon Fresh. And that makes the total bill over $250 a year. The math just does not work out for somebody who's financially struggling.
Joe, clearly Amazon's going after Walmart with this strategy. But let's face it, Walmart has made a mint off of these low-income people with these low everyday prices.
That's true, and when you get into government benefits, I think there's a real case to be made about how Walmart has profited from all of us in how that they pay their workers so little that they have to essentially game the system in order to make enough money to feed their families and to survive. Really, we are subsidizing this corporate giant's profitability to a large degree. So it's certainly about time that somebody challenged them. I just don't see how this is going to help individual people on government assistance.
Yeah, Derek, you get the last word here. Does Amazon have to, rather Walmart have to answer to Amazon's move or not?
Well, the big picture is this. Amazon is trying to become Walmart faster than Walmart can become Amazon. Amazon is trying to go build products for low-income households faster than Walmart can build e-commerce sort of offshoots of its company. They're competing against each other, and that's good that they're competing against each other. I agree with Joe's final point. I think that we're dealing with two extremely separate issues here, government policy and corporate policy. On government policy, we should have transfers to the low income to help them pay their bills, to help them buy food. But on corporate policy, it is good. It is good for companies to offer lower income families a discount so that they can buy certain products if they so choose. I can't think of a good argument against a company doing so.
Very good discussion, gentlemen. Derek Thompson from The Atlantic, Joe Rideout from Consumer Action. Thank you both.
Thank you.
Thank you.
Coming up, smart medicine. Meet the startup that helps patients take their meds. Uber has reportedly fired 20 employees. This follows a company investigation into sexual harassment claims at the ride-hailing company. Privately held Uber also told staff today that it will expand its employee relations unit to better investigate claims and that it plans to increase management training.
Anthem plans to exit most of the Ohio Obamacare market next year. The health insurer says that its decision is due to the uncertainty over whether the government will continue to provide subsidies aimed at making those plans affordable. Republicans are trying to cut off the payments in court proceedings, and the president has made conflicting comments about whether the government should in fact continue paying them. Anthem is, of course, one of the largest sellers of individual plans on those health exchanges.
Seattle has become the latest city to tax sugary drinks. The measure, which was passed late yesterday, will go into effect in January. The new tax is expected to generate about $15 million in revenue a year. The law was opposed by the beverage industry, which said that tax will hit working-class families and small businesses the hardest.
Entrepreneurs and innovators are gathering in New York for the Iconic Conference, presented by Inc. magazine and by CNBC. Its purpose is to help business owners revolutionize the way that they do business. And Kate Rogers spoke to one businessman who is rethinking the way we take our medicine.
One of the biggest challenges for healthcare providers today is getting patients to actually take their medication. AdhereTech is out to change that.
We make patented smart pill bottles that track and improve medication adherence in real time.
The bottles are loaded with state-of-the-art technology to tell when patients take the medication, with sensors that measure the open and close of the bottle and additional sensors that measure the contents. If a dose is missed, the bottles light up and chime to remind patients to take their pills. The technology can also prompt reminder phone calls, text messages, or even activate doctor interventions. But you don't have to be tech-savvy to use them.
Our average user is 70, and about a third don't even own cell phones.
AdhereTech partners with pharma companies, pharmacies, and hospitals, including Dana-Farber Cancer Institute and Weill Cornell Medical, to provide the smart bottles to patients for free, distributed from some of the largest pharmacies across the globe.
They're being better at remembering. It puts them on a schedule. So patients have actually changed their behavior in response to having the bottle.
To date, they've raised $2.4 million in funding from investors, including GE Ventures, and have thousands of bottles on the market in 4 continents, streaming patient data back to providers in real time.
AdhereTech is continuing to expand in the U.S. and internationally, and the startup says it's already profitable. For Nightly Business Report, I'm Kate Rogers, New York City.
I can think of lots of people that would benefit.
Absolutely.
You're looking at 2 of them
Two
right
of them
here.
right now.
Exactly.
On that note, that's Nightly Business Report for tonight. I'm Sue Herrera. We want to remind you that this is the time of year your public television station seeks your support.
I'm Bill Griffith. Thank you for your support. Have a great evening. We'll see you tomorrow.